Very good morning to you. I'm Malcolm Grahamwood, and I'm here again at Core Finance TV to do another CEO interview. I'm absolutely delighted that Andrew Knott, who's the CEO of Savannah Petroleum, has joined me again. Good to see you again, Andrew. God, there's been so much going on. Just to begin with, for those people who don't know much about Savannah Petroleum, perhaps you give us the overview, and then we'll start digging deep.
Yeah, so Savannah's an AIM-listed oil and gas company. We've been around now for over 4 years. Two principal asset bases, one in Niger, one in Nigeria. In Niger, we have 50% of the main petroleum basin under license. In Nigeria, we're in the process of acquiring a business that supplies about 10% of the country's power supply. Very fortunate that we've got a shareholder register which is about 82% institutional and includes some of the largest fund management houses in the world. And that's given us a very strong platform to deliver the growth that we've managed to deliver over the course of the last 4 years.
And I've said this before, but I'll say it again. I've met them all, and you've got a great, strong management team.
Yeah, so if you look, for those that want to, if you go on our website and look at the board, you'll see we've got all the main skill sets covered: political, financial, engineering, geological, legal, etc., etc. And then underneath that, we have a very strong management team. They've got experience of delivering the sorts of projects which we're pursuing. Right,
straight to the cut to the chase, as they say. Last week you announced some very exciting news with regard to the Seven Energy. Let's go through it in some detail because that's what it deserves. So why don't you talk us through what you've done?
Okay, so what we announced was, there was really three things that we announced. The first was that we are swapping the oil, an interest in a relatively small oil field plus some cash, for the portion of the gas field that we're acquiring equal, which we were not previously supposed to be acquiring. We also announced that we're buying out the minority shareholders in a holding company which we intend to use to operate the Stub Creek field. The net impact of those transactions is they increase the reserve and resource base we're acquiring by about 19%, or 25 million barrels of oil equivalent. But most importantly, they consolidate our control. So it means that across the gas value train, we'll be in a position where we have a very high degree of operational control over what happens. That enables us to set the growth agenda, that enables us to determine how rapidly we're going to move forward, and it also enables us to have full control over the cost structure, which is clearly very, very helpful, and it suits the sort of company that we are, whereby we want to be in control of our own destiny. We want to be able to do things to our pace, not to those of others.
So you get 100% of the Uko field, and you get 51% in Stub Creek, and the outgoing is a few millions of dollars now, and then a bit down the road in local currency. And you know, the cost savings must be quite substantial. You were saying last week that G&A and drilling efficiencies and so on are going to be pretty useful here.
Yeah, so I mean, we're still in the process of working our way through how we do the transition process with our partners, but clearly we would anticipate that as we grow the business, we should be able to generate some significant synergies, and we'll be talking more about them in the future.
Good. Now, AccuGas, which, as you know, I've always liked this business. There was an update in there about AccuGas as well, isn't there? There's quite a significant change there.
So, for those that aren't aware, Uko, which is the field we did the gas for oil swap on, that's the cash engine of the business. That's what generates the free cash flow in the business today. That field then sells into a midstream business, which is a gas processing facility in a 260-kilometre pipeline network called AccuGas. And then AccuGas ultimately sells on to the customers. The AccuGas is the only significant gas transportation and processing businesses in that part of Nigeria, which is a very high demand growth area. So there's two key things to understand about AccuGas is that from a supply perspective, there's about 40 trillion cubic feet of undeveloped gas which sits in the area, which could theoretically be tied in to the infrastructure. And then from a customer demand perspective, the primary source of competing power to gas is diesel. Now, diesel's got two big problems. One is it's very expensive. It's $15 an MCF equivalent versus our current average realised gas sales price of $3.50. And secondly, it's not reliable. It's intermittent. So the challenge in terms of for us as a management team in terms of growing that business is what you want to do is you want to link up that undeveloped gas using the infrastructure that we have and then sell it on a much higher margin basis to new customers. And the good thing is it's a win-win for all parties because if you're sitting on gas which can't be developed and you don't have the infrastructure, by definition developing it's a win-win. And then on the sales side, if the sorts of price that the heads of terms have been signed at $7.50 an MCF is a doubling of the realised gas price of the Aki gas business, but it's also a halving of the sales price that these guys are paying for diesel. So it's a good business.
So you're building a pipeline spur, which will give you, and then the access to these new customers, and you've, as you say, you've signed up 3 already.
Yeah, and we expect that to be the first of several projects that look like this. So I think when we originally announced the deal, the focus was on the value that we were acquiring relative to what we were paying of the existing assets. And I think what's really changed over the course of the last 9 months is that we're now much more focused upon the growth opportunities associated with those assets. So, which these additional contracts, etc., that I just talked about. But the Calabar Gas Distribution Project is a prime example of that sort of project. I mean, 20 million scuffs a day of incremental capacity that's capable of providing about 80 megawatts of power. If that was all fully contracted at $7.50 an MCF, that's over $50 million of gross revenue net to Aki Gas. Half of that stays with Aki Gas, half of that broadly goes into the upstream. And that's something which it will take time to ramp up, etc. But from the early 2020s, you're going to get a very significant cash flow stream coming out of that project, assuming all goes to plan. And because you can leverage off this big infrastructure base, the marginal return should be high because the capital's been sunk in putting it in place in the first place. And
you say you're supplying 10% of Nigeria's power needs, which, and at that price, is going to be a very good thing going forward. So, one of the questions that's been asked of me over the last few days is that how does this affect the timing of the completion of the Seven Energy deal? Obviously, it's obvious from the moment you look at it, you think, this is what they've been working on for months, but they still haven't completed it. What's the time process for that now?
So there's really 2 aspects of the transaction. Like clearly, when you're negotiating transactions like this, they take as long as they take to negotiate. I mean, that's just basically what you've got to accept. The knock-on implications of these transactions are that they impact 2 things. Firstly, they impact creditor security packages, which have to be reflected in the documentation. And secondly, they impact the government approvals that we are seeking to receive. Both of those parties have been fully aware and engaged and involved in the process, in the process of these transactions, so nothing comes as a surprise, but there is a knock-on impact. So we now expect to sign the implementation agreement, which is the core document which basically leaves the rest of the process mechanical, and that should be next month, and then I would anticipate hopefully the following month that we'll get completion, and then we can really move back into sort of focusing on the growth mode in the business.
Excellent. And while I'm on the subject, before we go away from the gas entirely, and the Calabar power station has been out of action for some time, as I understand through reading about it. It's back on. It's back on now, and
so it came out of maintenance. Now, the way that business works is that there's take or pay contract volumes of about 25,000 barrels a day, which is that's the volume upon which we get paid upon. So the intention is that we will now be able to ramp up to the same level of production that we were exhibiting in Q1 when Calabar was back on stream. But clearly the primary governing factor here is the take or pay volume, so they don't change.
Yeah. So, in a sort of follow-on from that is that how your cash position is within the company. Obviously, you did a raise. You had plenty of money for all this. You've obviously been doing more and more things. Is to talk us through the cash and the burn.
Okay,
and
so in terms of we're in close period, so there's only so much we can say. But I think if you look at the way we structured the deals that we announced, is that they effectively self-fund. So what I mean by that is that the gas for oil swap, the reduction in oil capex is greater than the cost of the acquisition going out, plus the revenue you're getting assets which generate revenues now, rather than for something which may generate revenue in the future. So that sort of looked after itself. In terms of the balance of the business, when we did the transaction at the beginning of the year, we obviously had to demonstrate the working capital. Clearly, we're not going to commit to stuff that we don't believe we can fund within the context of the deal. So the financial structure that we have also has a lot of flexibility. And the reason why I would say that is with the discoveries that we've had in Niger, the optionality we have around future funding options should we choose to accelerate even further than what we're currently doing in Niger. There's quite a few different ways that we can do that. We can do that through partnerships, we can do that through additional facilities, all those sorts of things. But we haven't made the firm decisions on any of that just now.
Excellent. Well, I appreciate that, given it's close season. Before I come on to Niger, I'm just going to say finally, in terms of why the shareholders and so on should like and are liking the progress you're making. I mean, obviously, you said it de-risks the Severn deal quite a lot, and it turns you into a full cycle E&P business across not only Nigeria, but we'll come to Niger in a minute. But that's incredibly good news, isn't it, for Savanna?
Yeah, and look, I mean, it's not like the business that we're acquiring has this, because of the infrastructure position, because we are doing something for which there's a lot of demand, i.e. gas. It has some very unique growth characteristics, which I'm not sure you see in other. It's not always prevalent in E&P, and the value is really that having access to that infrastructure, which really enables that growth. Yeah,
brilliant. Now, obviously, we've been mainly talking about that, but it would be remiss of me not to talk about Niger because it's going so well. You've got 100%, 4 out of 4 success ratio on the wells, and then you can't talk about Zomo because it's still drilling. So I'd love to know a bit more about where you're going from here, because there's not a plan. I mean, there are several things that I noticed have been done. First of all, you did the MOU with the Republic of Niger government. We've got the EPS on R3 and selling as soon as possible oil straight into the local refinery. And then we can come on to pipelines and so on after that. So why don't you talk me through what's going on in Niger at the moment?
Okay, so in terms of the drilling, as you said, we've now drilled 4 wells. The primary play, the main target, was successful in each of those wells. And we continue with the drilling program into the Zomo well. I think at a very high level, if you look at the questions or challenges that we faced when we first started off in Niger, the first was, can you finance it? The second was, okay, you can finance it, but can you operate? The third was, well, fine, but is there any oil there? And then the fourth is, fine, you can find oil, but how are you going to get out of the ground? And I think we've now made really good progress on all 4 of those fronts. Yep. So the financing thing, we've dealt with that. The second issue in terms of operations, well, everything we've done from seismic to FTG to the drilling itself, we've proven it can come in ahead of time and budget. That's as much a function of the straightforward operating environment and the fact the infrastructure and logistics have been established in the basin a long time before we got there, that we've been able to do that. But regardless, we've been able to do it. Obviously, we've got good people as well that make things happen. The geology, I think what we've shown is, like, for example, if you take Bushaya and Kunama, they were structures that you could see on the existing 2D seismic that we inherited. You then take Amdi, you needed the 3D seismic to see that, and that's the biggest discovery. So, and then the last one was a well that was, Eridal was a well that was previously thought to be a dry hole, which actually is probably the second largest discovery we've made. And what that says in aggregate is that within the acreage that we've got, there were opportunities that just hadn't been drilled. So Bushaya, Kunama, so et cetera, et cetera. Then by acquiring additional data, you get Amdi, so additional data helps. And then just taking a different technical view, like with Eridal. So I guess what I'm trying to say is that we've always said that there's a lot of potential in the acreage, both for the obvious stuff and the not so obvious stuff. And I think with the drilling that we've done to date, we've pretty much demonstrated that.
So in terms of selling the oil, we saw some weeks ago your thing about the selling into the local refinery. So the early production system is going to be selling oil maybe next year into the local refinery, and then you've got the situation regarding the pipeline, and there's been some sort of news on the pipeline very recently, hasn't there?
Yeah. So if you rewind the clock back to when we listed, we always said that, well, not always, that what we said at the time was our base case was it would go through Benin, because that was just politically the most obvious place to go. What you've then seen is tremendous progress in terms of an export pipeline going into northern Nigeria. And now what we're seeing is a move whereby there will be one export pipeline which goes to both Nigeria and to an export terminal in Benin. And the momentum and the pressure is behind getting all the pre-feasibility studies completed for this by the end of this year. And Savannah is fortunate enough that, as far as the export project's concerned, we now sit on the technical committees which are sort of moving this forward. So I think we've seen great progress on that. And then in terms of, but that's a 2021 first oil project. And that is something which we anticipate the major operator in the basin will elect to fund. In terms of the domestic capacity, we signed a deal with the Ministry of Energy and Petroleum of Niger a couple of months ago, which will enable us to basically go a very short route, 120 kilometres in a truck, to a tie-in point to the existing pipeline to the refinery, 463 kilometres. That's economically vastly superior to what we'd previously been talked about in our competent persons report, because that assumed a 700 kilometres trucking into northern Nigeria. What we will do is we'll be providing a full update on the economics associated with that in the near term, once our competent persons, GGG Robertson, has completed the work verifying the pre-feasibility studies that we're preparing to send to the government of Niger. But I think people will very shortly get a full understanding of just how the economics work and how straightforward a development is. And
I remember when we talked about it 4 years ago, when we, in that old office with the things on the wall, is that making sure that delivery was possible. We all sort of believed, because of CNG and so on, that the oil was there, but the delivery, and I think that's such a key thing for the shareholders to know right at the moment.
Yeah, and look, I think it will be a great achievement if and when we deliver first oil less than 12 months from discovery. I mean, I think that is that's something that everyone in the company is fully focused around, and I expect us to be able to deliver.
Yeah. This is nothing to do with Savanna as such, and I don't really expect to comment, but I did notice that the UK government is setting up an embassy in Niger, and for me that's just a thing of saying, this is a country that not many people have heard of that much. You've put it on the map to a certain extent, and this can only help, I imagine, but...
Yeah, so look, it's obviously great. The more involvement that the UK has in Niger, it's great for us and it's great for Niger. So it's great news.
As ever, the time flies, Andrew, and we've nearly finished, unfortunately. But it's particularly important, given so many things you're putting together, and you must be juggling all the time. The usual question at the end is, where would you like to see Savannah Petroleum in 12 to 18 months' time? You're hitting your targets ahead of schedule, but where would you like to see the company?
Okay, so we should have delivered first oil and be generating significant cash flows from Niger. I would expect us to have found significantly more oil than we have today. This would be in the Niger side of the business. And we may or may not have elected by that point to introduce a partner. In terms of the Nigerian side of the business, clearly in the very short term I expect the deal to complete. Once the deal is completed, I expect us to move to focus on consolidating what we have and growing it. On the growth side, the Calabar gas distribution pipeline is an example of the sort of project that you can expect us to be pursuing. There are other similar projects which we should hope to be able to mature and talk about over the course of the next 3 to 9 months, I would suggest. And then we will be looking at other ways to get more gas through the network. But I think the key thing is, because of the infrastructure, I would reiterate again that the capital intensity of these bolt-on projects is not going to be significant. and vendors' expectations reflect the fact that they do not have access to the infrastructure. So a win-win, there's a lot of win-win deal opportunities in that Nigerian business, in my view.
Fantastic. Thank you very much for coming in.
Thank you.
It's been great to interview again Andrew Knott, the CEO of Savannah Petroleum. It's been great to be on Core Finance TV. My name is Malcolm Graham Wood, and I look forward to seeing you again soon.